that while retail investors are running for the exits, the smart money is doing something very, very different. We have just uncovered a massive, unmistakable signal buried deep in a brand new SEC filing that changes the entire narrative. This isn't speculation. This is public record. Eric Schuppenhauer, the executive vice president of Borrow at SoFi, has just made a move that should send chills down the spine of every short seller. Think about who this man is for a second. He isn't just an executive. He is the man who oversees the lending engine. He sees every single loan, every delinquency trend, and every default data point before it ever hits a quarterly report. If the economy were truly collapsing, if borrowers were on the verge of mass default, would the head of lending be dropping $100,000 of his own cold, hard cash to buy the stock on the open market? Absolutely not. He would be hoarding cash. Instead, he is loading the boat. He is putting his money where his mouth is because he sees the internal data that we don't. And his wallet is screaming that the credit crisis fears are completely overblown. But wait, because the insider buying is just the tip of the iceberg. While the rest of the market is distracted by the doom and gloom of today's sell-off, massive rumors are exploding behind the scenes. There is chatter that SoFi is secretly preparing to launch prediction markets. For those who don't know, this is essentially the free money glitch of the fintech world. We are talking about a platform that allows users to trade on the outcome of real-world events, elections, economic data, pop culture. This is a potential revenue goldmine that is completely uncorrelated to interest rates. It prints cash, regardless of whether the economy is booming or busting. This is a move backed by the philosophy of legends like Tom Lee and theories popularized by Michael Lewis, yet Wall Street hasn't even begun to price it in. When you combine that hidden catalyst with JPMorgan slapping a massive aggressive $31 price target on the stock, we are staring at a textbook bear trap. The short sellers are piling in, betting on a crash, but the insiders are buying the dip at $19.93, creating a concrete floor under the price. This is the Goldilocks setup of the decade. Explosive growth potential, aggressive insider buying, and a massive short squeeze waiting to trigger. Do not let the fear shake you out of the trade of the year, because when the smoke clears, the only people winning will be the ones who followed the insiders, not the panic-inducing headlines. Let's address the elephant in the room. We are looking at a total sea of red on Wall Street today, Friday, February 6th. The damage is widespread and massive. The Dow Jones is plunging nearly 600 points, and the Nasdaq is diving over 1.5%. But the real story, the story that should concern you, is exactly what is happening to SoFi right now. This isn't just a standard red day. This is a calculated execution of growth stocks. We are witnessing the smart money brutally rotating out of high-growth fintech and running for safety. Look at the data. While the S&P 500 and Russell 2000 are tanking, we are seeing a weird, almost paradoxical phenomenon where boring dinosaur regional banks are actually flashing green. That is arguably the worst possible signal for SoFi holders in the short term, because it proves investors are fleeing the future to hide in the past. They are dumping innovation for stagnation. SoFi is getting hit with a triple whammy today because it sits directly in the crosshairs of the three worst performing sectors. Financials are down, technology is crashing, and consumer discretionary is collapsing over 2%. SoFi is a blend of all three. This is the perfect storm we warned you about, where high beta stocks get crushed twice as hard as the broader market. And with that post-earnings softness still lingering in the chart, this sell-off is amplifying the pain to levels we haven't seen in months. The algorithms are currently programmed to sell everything that even looks like growth. If you think this is just a standard dip, you need to look at the sector rot happening underneath the surface. The rotation into defensive value stocks is accelerating, and it is leaving retail favorites like SoFi out in the cold. Why is this happening today? The economic data just dropped, and it is flashing a massive warning signal for the entire fintech sector. If you were wondering why the stock took a sudden dive at the open, you need to look at the numbers from February 5th, because they are absolutely shocking. We just saw a massive surge in challenger job cuts, hitting a staggering 108,000. That is nearly triple the previous month and way above anything the market expected. This is a clear, undeniable sign that companies are slashing roles aggressively. For a bank like SoFi, which relies on high-income professionals having steady paychecks to pay back their personal loans, This is terrifying news. It gets even scarier. Jolts. Job openings collapsed to just 6.5 million, missing the forecast by a huge margin. This means hiring is freezing up at the exact same moment that firing is ramping up. When you combine skyrocketing job cuts with rising jobless claims, now sitting at 231,000, you get a recipe for a potential recession and, more importantly, higher loan defaults. The market is panicking that we are heading for a hard landing. Even though this data might force the Federal Reserve to cut rates faster, the immediate fear is that borrowers are running out of cash. This data caused a 6% drop for a reason. You need to be extremely careful because if the labor market continues to crack like this, the pressure on SoFi's loan book could get much heavier in the weeks ahead. Do not ignore these critical warning signs. They are the fundamental gravity weighing down the stock. Now, let's look at the charts because they are screaming a warning signal that nobody is talking about. We just saw a massive 6% crash, wiping out weeks of hard-fought gains and dragging SoFi down to $19.46. $19.46. But the real story is hidden in the options chain that expires today, February 6th, 2026. Look at the open interest data. The institutional bears have built a massive wall at the $20 strike price, with over 9,000 put contracts betting against you. This has created a danger zone that the stock is currently drowning under. As long as we are below $20, market makers are incentivized to keep the price suppressed to ensure those puts pay out. This isn't just about SoFi in isolation, it's a global contagion. We are seeing giants like Sony and BBVA missing revenue estimates, dragging the entire financial sector into the mud and sending panic waves through the trading algorithms. The technical indicators are flashing a code red. The stock is now trading well below its 50-day and 200-day moving averages. We have confirmed a major bearish crossover, the 50-day crossing below the 200-day, which is often a lagging but powerful signal of long-term downward momentum. However, here is the twist that could make or break your portfolio in the next 24 hours. Zoom in to the 10-minute chart. We are seeing a secret divergence. While the price is making lower lows, the MACD is starting to cross over to the upside, and the RSI is bouncing hard from oversold levels. This suggests that the selling pressure is exhausted, and a potential trap for the bears is forming right now at $19.65. Here's your game plan. The bull case. If the bulls can smash through that $19.65 resistance and reclaim the psychological $20 fortress, we could see a massive short squeeze explosion. Those 9,000 put contracts would get wiped out, forcing market makers to buy back shares to hedge, fueling a rocket ship higher. The bear case. If we reject here at $19.65 and break the critical floor at $19.19, we are flushing straight down. The next support is $18.57, and we might even test the yearly lows. You have two clear paths for this session. Watch for the reclaim of the $20 level for a moonshot, or prepare for the flush to $18 if the bears keep control. Keep your eyes glued to the $19 support because the next move is going to be violent, and you do not want to be on the wrong side of this trade.